We're analyzing Comcast, stock ticker CMCSA, to see if its market price is a fair value. We're using the Select 6 analysis to look at the most telling financial metrics before estimating an intrinsic value for Comcast. Then, we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing Comcast for your portfolio. Before we get into these valuable metrics, let's understand Comcast stock performance. Now, Comcast trades for $37.22 per share. In the last year, their stock price is down 19.5%. In the last 5 years, their stock price is compounding at just under 3% annually. In the last 10 years, Comcast is compounding at 6% annually. Going back prior to the global financial crisis, over the last 18 years, Comcast is compounding their stock price at about 7% annually. Currently, Comcast pays an above average 2.9% dividend yield. Their average dividend yield throughout this time is in addition to their compounded annual returns in their stock price. Comcast trades $11 below their 52-week high. The company is up $9 from their 52-week low. 1.5% of their shares are sold short. Comcast is a very large business. They have a $159 billion market cap. But why should we be paying close attention to Comcast? Comcast is made up of three parts. The core cable business owns networks capable of providing television, internet access, and phone services to roughly 61 million U.S. homes and businesses, or nearly half of the country. Around 55% of the homes in this territory subscribe to at least one Comcast service. Comcast acquired NBC Universal from General Electric in 2011. NBCU owns several cable networks, including CNBC, MSNBC, and USA, the NBA broadcast network, several local NBC affiliates, Universal Studios, and several theme parks. Sky, acquired in 2018, is the dominant television provider in the United Kingdom and has invested heavily in exclusive and proprietary content to build this position. Sky is also the largest paid television provider in Italy and has a presence in Germany and Austria. Starting with metric number 1, we want their average return on capital in the last 5 years to be above 14%. There are two key reasons for this. The average publicly listed business earns about a 7% return on capital. Over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns. These business returns will be captured here by return on capital. Looking for a benchmark that's about double the average allows us to build in some margin of safety for ourselves based off the quality of the business. Comcast has increased their returns on capital in the last 5 years. They earned just over 10% returns in their most recent fiscal year. Over this time, Comcast earns about a 9% return on capital in a given year. This is a couple percentage points above a typical business, but this is well below the 14% we were looking for, meaning this is an X on metric number 1, starting things off for Comcast. Metric number 2, we want to see 5-year revenue, net income, and free cash flow growth for Comcast. This metric is all or nothing. All three of these have to be up for this to be a check. During this time, Comcast has grown their revenues by 28%. At the same time, their net incomes are down. This was due to $8.3 billion of non-cash impairment charges related to goodwill and intangible assets in Comcast's Sky segment. They took this hit in the third quarter of 2022. It reflects reduced estimated future cash flows as a result of poor macroeconomic conditions in Sky's territories. Put more plainly, it looks like Comcast overpaid for their Sky acquisition, and with tougher economic circumstances, Comcast had to take this impairment. One bright spot for the business is over these last 5 years, their free cash flow has grown by 10%. Even still, with their net incomes down over this time, this is an X on metric number 2. Metric number 3, we're taking the perspective of an individual shareholder in Comcast by looking for earnings per share growth over the last 5 years. As we learned, because of their big impairment of goodwill, their earnings are down over this time. In the last 5 years, Comcast has bought back about 5% of their shares, yet their decline in their earnings is outpacing these buybacks. This is an X on metric number 3. Metric number 4, we're looking for free cash flow per share growth in the last 5 years for Comcast. Here's where we finally get some relief. Comcast has grown their free cash flows over this time, and they bought back 5% of their shares outstanding. This has led to modest free cash flow per share growth for Comcast. This is our first check of the day, coming in on metric number 4. Metric number 5, we're looking at how Comcast uses debt. During economic downturns, it's overly levered businesses that are likely at the greatest risk of poor outcomes. Comcast has reduced their net debt position over this time. In absolute terms, this is a huge amount of debt. We want to look at at it relative to their free cash flows, during this time, Comcast has produced $77 billion worth of free cash flow. That's coming in $30 billion shy of their net debt position. This is an X on metric number 5. It may or may not be a potential concern here for Comcast. Cable and telecom operators tend to use large amounts of leverage in their business. If this is a concern, you'd want to dig into Comcast filings, where they'll break out their debt profile in more detail. Before we get to metric number 6, let's not forget about our bonus. Here we're looking at Comcast's dividend profile. Right now, Comcast pays a high 2.9% dividend yield. However, people make mistakes all the time by blindly chasing dividends. It's important to stop and look at the underlying fundamentals of a business to see if they can support their dividends. Comcast has grown their dividends through all 5 of these years, and at the same time, they both increased their free cash flows and they bought back shares while maintaining a pretty conservative dividend payout ratio. While this is a snapshot of their last 5 years of performance and it's no guarantee for the future, it would seem that Comcast dividends are well supported by their cash flows here. Keep in mind the leverage issue that we just touched on. Free cash flow can be used in a handful of ways for a business. They can buy back shares, pay down debt, pay dividends, make acquisitions, or reinvest back into the business. You'll want to be mindful of how Comcast management is approaching capital allocation. The big metric of them all, metric number 6, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this will give a slight risk premium to the yield of the 10-year treasury. It may also offer a reasonable starting point for a valuation of Comcast. Comcast currently has a $262 billion total enterprise value. This takes into account both their market cap and their net debt position. It gives us a perspective of Comcast that's more similar to Comcast being a private business. In the last 5 years, we learned Comcast has produced $77 billion worth of free cash flow. In an average year, Comcast produced about $15.4 billion of free cash flow. When we divide that by their $262 billion total enterprise value, that gives us about a 5.9% average free cash flow to enterprise value yield for Comcast. The company has produced about the same amount of free cash flow in their most recent fiscal year as what they produce on average, meaning they have the same current free cash flow to enterprise value yield as well. Both of these are coming in slightly above that risk premium we were seeking. This is a check on metric number 6. Just because this is the case doesn't mean you run out and go buy the business. This is not a buy or sell recommendation of any security. It's not financial advice. You'll want to stick around as we come to a more concrete estimate of their fair intrinsic value and give our rating to Comcast. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Comcast, which takes us on to using a discounted cash flow model to come to an estimate of a fair intrinsic value for Comcast. A DCF model is based off the predictability of a business's free cash flows. It's like any model in any discipline, its outputs will be sensitive to its inputs. We're starting with an average of Comcast free cash flows in the last 5 years, then growing these into the future using historical growth assumptions. It's up to you to do your own homework here. Assuming Comcast grows their average free cash flows at a rate of 10% annually for the next 10 years, then this growth rate is cut in half for the 10 years following that. If we add in the company's tangible book value, which gives us an estimate of their tangible net worth, and we were seeking a 15% rate of return, which is the rate of return Warren Buffett is looking for from his investments, in addition to his margin of safety requirements. At today's valuations of Comcast, an estimate of their fair intrinsic value is around $15 per share. This is cutting their current stock price in half. There are key factors you want to be mindful of here. Comcast has been a relatively predictable business in its past. That's not necessarily a guarantee for the future. This rate of return would be dramatically outpacing how Comcast has fared in their past couple of decades. Their dividend yield would also be included in this 15% discount rate. Keep in mind this is just an estimate of their tangible book value. That impacts our assumptions here as well. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Before considering any potential investment decision, consult with your financial advisor. In just a minute, we'll give our rating to Comcast, but we have to address something first. What are the qualitative aspects of this business? Starting with the key factors supporting a potential long thesis of Comcast. Number 1, with direct access to consumers across the United States and Europe, few companies have as many ways to monetize content investments, which should make Comcast a destination for the best writers, directors, and actors. Number 2, dense fixed line networks provide Comcast with the opportunity to push deeper into the business services market and potentially play a crucial role in the development of 5G technology. Number 3, Comcast cable networks provide a platform to easily meet meet consumers' growing bandwidth demands, which could drive steady market share gains, ensuring that recurring revenue and cash flow remain strong for Comcast. Then the key points supporting a potential short thesis. Number one, with over $100 billion in debt, Comcast may not have the financial flexibility to pursue major strategic opportunities in the future. Number two, Comcast's reputation for customer service is poor at best. If 5G wireless provides a credible alternative, millions of customers are ready to switch internet access providers. Number three, Comcast businesses are heavily exposed to the traditional TV model. As more consumers turn to online alternatives, the firm could struggle to post any revenue growth. There's a balanced perspective of some of the qualitative aspects of the business. Now it's time to give our rating to Comcast. In analyzing Comcast, stock ticker CMCSA, we learned the business earns above average returns on capital, just a few points above a typical business, but below the benchmark we're looking for. Comcast has grown their revenues and their free cash flows in the last 5 years. They took $8.6 billion of impairment charges related to their Sky acquisition. This sets back their net income. They've also bought back 5% of their shares. In absolute terms, Comcast has some of the most debt of any business in the world. They have over $100 billion in debt. This may or may not be a potential concern, but it's more debt than what their free cash flows look like they can support. On both a current and an average basis of their free cash flow to their enterprise value yields, those were both coming in above the yield of the 10-year treasury and slightly above that risk premium. Comcast has also supported a growing dividend in the last 5 years. With all the factors of our analysis in mind, it looks like Comcast is a weak candidate for further research. Don't let that discourage you if you're potentially interested in the business. When performing our discounted cash flow analysis, if you've done the work and you believe those historical growth assumptions, at today's valuations of Comcast, if you are seeking a 15% rate of return, an estimate of Comcast's fair intrinsic value is around $15 per share. That's quite a bit below today's prices of Comcast. The last time the business was at those levels was back in June of 2012. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, comment down below what business you want me to take a look at next time. Thanks for learning about Comcast with me, and have a great day.